Hello fellow boomers, welcome, get ready for some amazing content. As we move into the third month 2025, the artificial intelligence sector finds itself at a pivotal moment. With investment in generative AI surging and attention at an all-time high, the landscape is set for significant transformations. This year, we anticipate substantial shifts driven by the emergence of large concept models, the development of specialized AI hardware, and major tech companies expanding their AI infrastructures. This is not important only to tech enthusiasts or tech investors. It is important to all of us, so stay tuned while we dive into it. These changes could potentially reshape the dynamics of competition, allowing giants like OpenAI and Anthropic to bolster their monopoly status. Let's see what that statement means. As artificial intelligence advances at an unprecedented pace, the balance of power in the industry is shifting. Companies like OpenAI and Anthropic, already at the forefront, are poised to tighten their grip on the market. With vast financial resources and cutting-edge research capabilities, they can develop proprietary models and specialized AI hardware that smaller competitors simply can't match. This creates a growing divide, where dominant players continue to set the rules, making it increasingly difficult for new entrants to compete. By expanding their AI infrastructure and securing exclusive partnerships, these tech giants can reinforce their market position, potentially edging closer to a monopoly. As a result, innovation may become concentrated in the hands of a few, limiting diversity in AI development. While this could lead to more powerful and efficient AI systems, it also raises concerns about control, accessibility, and the long-term impact of centralized artificial intelligence on society. AI companies, however, face a unique challenge. They navigate a realm that blends both software and hardware dynamics. Unlike traditional software firms that benefit from low operating expenses, or hardware companies with tangible capital investments, AI enterprises are caught in a precarious balance. They need hefty investments, often in the range of hundreds of millions of dollars annually, primarily for GPU clusters and infrastructure. Let's break it down. AI companies operate in a hybrid space where innovation depends not just on code, but on vast computational power. Their growth is tied to securing advanced hardware, primarily GPU clusters, making their operational costs more like those of energy-intensive industries, rather than traditional tech firms. This constant demand for high-end infrastructure creates a financial barrier that only the biggest players can afford to overcome. Yet, unlike hardware companies, they must show significant growth within compressed timelines, creating a cycle of dependence on continual funding. Adding complexity to this environment is the ongoing convergence of large language models, or LLMs. Companies like Mistral AI are demonstrating the power of open-source models that rival their closed-source counterparts. But as performance benchmarks become standard across the board, our ability to differentiate between them diminishes. This lack of significant architectural advancements foreshadows a plateau in capabilities, where gains stem from improved efficiency rather than sheer scale. As we've seen, the collective speed of innovation in the past 2 years has surprised many, leading to an accelerated race for survival among startups. Looking ahead, the emergence of large concept models, or LCMs, will introduce a competitive alternative to LLMs, particularly in natural language understanding. With their potential for superior performance achieved with fewer iterations, these models are expected to be developed by spin-off teams of former big tech pioneers eager to drive this innovation forward. Yet, this rapid evolution comes with its own set of challenges. We are witnessing a mismatch between product timelines and sustainable monetization strategies. Today's AI startups face immense pressure to morph from R&D focused to sales-driven entities within mere years. For instance, a startup valued at $20 billion will likely need to generate at least $1 billion in annual revenue in the next few years to maintain investor confidence. An ambitious goal that requires a complete overhaul of their business model without stalling innovation or exacerbating infrastructure costs. The current state of hardware availability compounds these hurdles. Major tech companies snap up GPU clusters even before they are manufactured, leaving smaller players with limited options. Faced with the choice of long-term contracts with cloud providers or risking market exclusion, many find themselves at a distinct disadvantage. Interestingly, despite the GPU scramble, There's a growing realization about inefficiencies in existing architecture. The general-purpose GPU, or GPGPU, simply isn't optimized for the actual needs of many companies in production. This has opened the door for specialized AI hardware, such as those developed by companies like Groq and Cerebras, designed specifically for inference workloads. While these alternatives may require higher upfront engineering investments, they promise operational costs that are significantly lower than conventional GPUs, an enticing proposition for organizations managing large-scale operations. In conclusion, as the field of AI continues to evolve and face these trillion-dollar problems, the emergence of smaller, more efficient models and specialized hardware may very well hold the key to sustainable and innovative growth. The race is on, and the next few years promise to reshape not only the technology we rely on but also the very structure of the industry itself. Smaller, more efficient AI models are shaking up the landscape. Companies like Microsoft and Google are leading with models like Phi-3 and Gemma 2B, which boast impressive performance despite having only 2 to 3 billion parameters, compared to the 8 billion of larger counterparts. This trend highlights a crucial advantage: data density. As these companies leverage vast datasets from platforms like Bing and Google Search, they're training smaller models that are both efficient and robust. However, the AI industry is facing two significant battles, one over compute power and another over the crucial resource of data. Access to extensive datasets provides a competitive edge to those developing smaller yet potent models. Investments from major tech firms signal a brewing competition for resources. With thousands of specialized engineers needed, this might lead to a wave of acquisitions, absorbing many startups. While the giants build their empires, smaller companies still have a crucial role in innovation, particularly in niche sectors. Adjustments in funding strategies could emerge, particularly for open-source AI, which may thrive in specific vertical applications where they outshine proprietary technologies. The future of AI continues to promise excitement and transformation. While AI continues to evolve at breakneck speed, what do you think will shape the industry's future? Will smaller, more efficient models redefine the landscape, or will the giants maintain their grip on power? How do you see the balance between open source and proprietary AI playing out in the years ahead? Let us know your thoughts in the comments below. And if you found this video insightful, don't forget to like, share with your friends and family, and subscribe our channel to stay updated on the latest AI developments. See you in our next video.